Hi everyone, Nick here, welcome back. I've had friends and family asking me about IBonds. They become very popular lately since they're yielding 9.62% currently. In this video, I'm going to share why I generally recommend against my friends purchasing IBonds. After that, I'll share what I believe is currently a better option than IBonds. First, let's briefly discuss IBonds. The IBond interest rate has two components, a fixed rate and an inflation rate. The fixed rate is currently 0%. The inflation rate is 9.62%. You can add these together to get the composite rate, which is obviously 9.62%. In finance, you'll often hear of two terms, the nominal return and the real return. The difference between these is the real return is adjusted for inflation and the nominal return is not. With IBonds, right now, the nominal return is 9.62%. The real return is 0%. This means you can expect money earned in your IBonds to only keep up with the cost of certain goods. In fact, the return on IBonds is even worse because you're taxed on the 9.62% interest when you redeem the bond. If you redeem the bond before 5 years, you forfeit 3 months of interest. You're basically guaranteed a real loss with IBonds, a negative real return. A guaranteed real loss is something we generally want to avoid. I've had friends in their 30s and 40s asking me about IBonds. These are people with long investment horizons, maybe 30, 40, even more than 50 years. Why would you want to lock in a guaranteed real loss at such a young age? If you're just trying to avoid losing money to inflation in your emergency fund or you're saving for a down payment on a house in a couple of years, IBonds may be a decent option. Most people believe the fixed rate will be increased next month, so they might have a positive real yield soon. I don't think it's a good idea to buy IBonds just because you're fearful of recent market events. I made another video on why I'm still buying stocks with every single paycheck, and why I believe market timing is a bad idea, which I'll link up here and below. People nearing or in retirement have a better reason to hold IBonds. But there's a problem. IBonds can only be bought in a taxable account. This can be an issue for both older and younger investors. If you're not maxing out your retirement accounts each year, any money you put in IBonds is a lost opportunity to build wealth in a tax-advantaged account. IBonds allow you to defer paying taxes on interest until you redeem them, but retirement accounts are far better for multiple reasons. First, you have more investment options in retirement accounts. Second, money in a Roth account grows tax-free and can be withdrawn tax-free in retirement. Money in a traditional retirement account qualifies for a tax deduction when you contribute. Third, your 401k is protected from creditors in bankruptcy. Your IRA may also be protected depending on the state in which you live. If this is news to you, I have another video detailing this and other asset protection strategies, which I'll link above and below. For younger people, I would expect the power of these tax-advantaged accounts and the asset protection over the long term to be far better than the short-term high nominal rate of IBonds. For retirees, or anyone for that matter, you may want to prioritize holding bonds in a retirement account and stocks in a taxable account, since bond interest is taxed higher than long-term capital gains and dividends from stocks, qualified dividends. I have a video on tax-efficient asset allocation with more details. This brings us to the final point. In my opinion, TIPS are currently better than IBonds. This isn't market timing, this is just evaluating what is the better deal on the market currently. TIPS are similar to IBonds, but TIPS currently have real interest rates of approximately 1.75%, whereas IBonds have a real interest rate of 0%. A year ago, TIPS had negative real rates. Yes, that is correct, it was negative. At the time, the 0% fixed rate on IBonds was a better deal, but now TIPS are guaranteeing a return above inflation. In addition, TIPS can be bought in a retirement account where they get the tax and asset protection benefits. TIPS are a bit more complicated than IBonds. I made another video with a more detailed comparison between TIPS and IBonds, and discussed a Vanguard research paper on the best ways to protect against inflation. But here are the highlights on how TIPS differ from IBonds. First, they are both indexed to the same inflation measure. They pay interest twice per year, they're exempt from state and local taxes, and they have low minimum investments. The first major difference is in how they pay interest. With IBonds, you have the fixed and inflation rate, but with TIPS, you only have the fixed rate. Instead of an inflation rate, the TIPS principal is adjusted for inflation. Let's look at an example. Let's say you bought $1,000 of IBonds and TIPS on the same day. The IBond has a 0% interest rate and the TIPS has a 2% interest rate. Let's say inflation was 10% in the first 6 months. Not the annualized rate, just for 6 months. Your IBond would yield 10% and the value of the principal of the IBond would be $1,100. Your TIPS bonds principal would also be adjusted to $1,100 and pay interest of 2% on the adjusted value. You would receive $22 in interest. Let's say that the next 6 months had a 10% inflation again. Your IBond and TIPS would both grow to a value of $1,210. Your TIPS, you would receive an interest payment of $24.20. Now let's say there is somehow 10% deflation in the following 6 months. Your IBond composite rate cannot go below 0%, so you would still have $1,210. Your TIPS principal adjustments can be negative. Your principal would go to $1,089. You would still receive the 2% interest payment on this amount of $21.78. This is one extra risk with TIPS. If there is deflation, your principal will be adjusted down. With IBonds, your interest rate will go down, but it won't go below 0. However, the TIPS principal cannot be adjusted below the original par value of $1,000 in the event of extreme deflation. This is if you buy a new issue at auction. One other disadvantage of TIPS is they are taxed differently. The fixed rate and the principal adjustment are both taxed in that tax year, even though you don't actually receive the principal adjustment. For this reason, it's usually best to avoid this by holding TIPS in a tax-advantaged retirement account. The next major difference is IBonds have to be bought from the Treasury and cannot be sold to other people. TIPS trade similar to other bonds and stocks on a secondary market, so you can even buy TIPS mutual funds. While there is a limit on how much IBonds you can purchase in a year, there's effectively no limit on how many TIPS you can buy unless you have tens or hundreds of millions of dollars. A lot of retirees will create what is called a liability matching portfolio, an LMP. Let's say a couple spends $80,000 per year, but only receives $60,000 per year from Social Security. They need an extra $20,000 to pay their bills each year. Let's say they want their liability matching portfolio to last 30 years. They can go out and they can buy a TIPS ladder with $20,000 of TIPS that mature in year 1, $20,000 that mature in year 2, and so on, up to 30 years. This would require $600,000, but would guarantee this couple wouldn't lose real value to inflation on that $20,000 of spending. Losing real value to inflation is one of the biggest risks retirees face, and one of the biggest risks with nominal bonds. TIPS are a great tool for a liability matching portfolio since they mitigate one of the major risks retirees face. I say mitigate because the US government controls the inflation measure that determines how much they have to pay you. It's possible that this number doesn't reflect the reality of your living expenses. I want to caution against market timing. You shouldn't just start buying inflation protection because we've had high inflation in the past year. However, I think a lot of people have underestimated the risk of inflation. TIPS are good when inflation is higher than the bond market expects, but they yield a little less when inflation is lower than the bond market expects. You will receive a little lower return if inflation is below expectations. But many people think this is a fair price to pay for what is basically inflation insurance. I personally think it makes sense to have some inflation protection in your retirement income. Social Security provides the bulk of the inflation protection, but maybe you want more to cover all of your core expenses. If you want to buy TIPS, there are several options. One option is to build a TIPS ladder. You could do it with the US Treasury's website for the lowest cost. You'll be limited to when the Treasury is auctioning TIPS and the specific maturities being auctioned, but you'll get the same rate as the big banks that are participating in the auction. One downside is that Treasury Direct doesn't do IRAs. You could also buy TIPS at auction or on the secondary market using a brokerage like Fidelity or Schwab. You can buy TIPS in an IRA with most brokerages. On the secondary market, you can buy TIPS of virtually any maturity, but you'll have to pay a commission or bid-ask spread to the broker. If you don't want to deal with the hassle, you can buy a TIPS fund and let them manage the TIPS portfolio for you. If I were retired, I would probably use a TIPS fund and allocate some of my bond allocation to TIPS. I'll share the TIPS funds I like the most. First is Fidelity's TIPS Index FIPDX with a 0.05% expense ratio and a 7.13-year average duration with no minimum investment. Next is Vanguard's TIPS Index VAIPX with a 0.1% expense ratio, 7.2-year duration, and $50,000 minimum investment. This fund is also sold as VIPSX with an expense ratio of 0.2% but only a $3,000 minimum investment. Next is the TIP ETF from BlackRock with an expense ratio of 0.19%, duration of 6.82 years, and a minimum investment of 1 share. Schwab also has SHP ETF with a 0.04% expense ratio, 6.9-year duration, also a minimum of 1 share. In my other video, we talked about a research paper that showed how historically short-term TIPS have provided the best protection against unexpected inflation. Vanguard has a short-term TIPS fund, ticker VTIP, ETF with a 0.04% expense ratio, a duration of 2.6 years, and a minimum investment of 1 share. This is also sold as a mutual fund, VTAPX, with a 0.06% expense ratio and $3,000 minimum investment. iShares also has STIP, STIP, an ETF with an expense ratio of 0.03%, duration of 2.47 years, and minimum investment of 1 share. It can be a bit complicated to understand what a TIPS fund is returning, since it's calculated differently than other bond funds, and major brokerages often show different rates or calculations. I think BlackRock does the best job since they report the 3 most important yields for a TIPS ETF. In my opinion, the real yield is the most important since it reflects the real rate for the bonds currently held by the fund. This doesn't include the fees, but you can use this to estimate what the real yield is for Vanguard and Fidelity's funds of comparable duration. As the bonds mature and the fund buys new ones, the real yield will change with the market. To recap, I don't like IBonds because they cannot be purchased in a retirement account. They're currently unattractive compared to TIPS. These are the main reasons why I often dissuade friends and family to not invest in IBonds. However, everyone is different. IBonds could still make sense for you. I just want to help people make more informed decisions and consider the trade-offs. Everyone's situation is unique, so make sure you do your own research, consult a professional if you need more help to navigate this complexity. If you want to learn even more about TIPS, let me know in the comments below. I can make more detailed videos. There's also a great book I recommend called Explore TIPS, A Practical Guide to Investing in Inflation-Protected Securities. It does a great job at explaining the most important details. If you got value from this video and you want to support free financial education, make sure to press the like button and share my content with your friends. Later.